The European economy has been surprising us in the upside since the recovery from COVID began. This shows a great deal of adaptation by all economic agents, firms, workers. I think the policies that we implemented, certainly at the ECB level, but also at other European levels, were also very important to feed this sense of confidence that the crisis, the COVID crisis, will be temporary. And this today is a little bit of the tailwinds that we still see for our economy. The recovery is not yet completed. Some geographies are still lagging behind. Some sectors still have some work to do. And the labor market has been performing amazingly well in Europe. This means
some might say too well.
Yes, but too well in a market such as the labor market, I really don't buy it. Let me tell you that I still see some progress to be made. The crisis, the COVID crisis, implied that mobility came to a halt. Europeans preserved their employment. Firms were very helpful on that, governments as well. So now we need to increase mobility. We need to increase churning, rotation in the labor market, because this brings about productivity, wages. We know that wages increase faster when churning is active in our economies. We need to focus on that part when we look at the European economy.
How encouraged are you by the fact that headline inflation has started to drop quite significantly?
I see this as the result of a highly coordinated cycle of tightening globally. Inflation in Europe peaked at 10.6% in October. Since then, we see it going down to 6.9% in February. This is very, very reassuring of the impact of monetary policy, of the way we implemented this tightening cycle as well, taking very seriously the issues on financial fragmentation and financial stability in Europe. We were very careful. We created the transmission protection instrument in July, right before starting to hike. This is a successful story so far. So I think
it's never been used, so
it is a backstop. It is a backstop,
exactly.
It is a backstop, and the backstop is meant to be there and to be used if needed. We are very happy to have it and not having the need to use it. But as I was mentioning to you, this is a global phenomenon because it is totally unparalleled in the history of central banking in developed economies that all central banks went to a policy of tightening in a very short period of time, all at the same time. This produces what we call in economy global spillovers. So it means also that the multipliers we are used to in our analysis do not apply. We need to be very careful about it because the risk of overshooting exists more when the cycles are of this nature. Let me give you an example. When Europe went through a spree of coordinated fiscal austerity in the context of the sovereign debt crisis, we got all multipliers wrong. The impact of fiscal measures taken in that context were way higher, way more negative than we first thought. We cannot take the same risk today because these global spillovers on monetary policy, this tightening process, very quick, very fast. It took us only 7 months to hike more than 300 basis points. The last time we did the same hiking process, it took us 3 years. And it was not global.
Yeah. So it sounds to me that you're a little concerned at how rapidly the ECB have hiked rates.
I'm sure that the tightening is making its way through inflation. I think the numbers we see today are a reflex of that. in a sentence, with these global spillovers on monetary policy, we can achieve more with less. That's my message.
Governor,
So,
is it time for the ECB to pause?
I think we need to look at what the data will tell us in the next few months. Certainly, we are much closer to the terminal rate than we were a couple of months before. This is a very simple statement, though. And I think we need to read the data very careful to understand that the monetary transmission mechanisms are at work. They are bringing inflation down. Our economy is doing better than expected because of the tailwinds that I just explained to you.